Hello, hello, hello. We are back, the Capital Spotlight podcast. I'm your host, Craig McGrother. Of course, as always, with the one, the only, Mr. Suit Supply himself, Rob Beardsley, the co-founder and principal of Lone Star Capital. How are you today, sir?
I'm doing well. I'm doing well. Kent and I were off site yesterday, which is something that him and I do quarterly. We do these quarterly off sites where we get away from the office. We don't try to have any scheduled phone calls or any sort of routine work. And instead, we focus on kind of budgeting, accounting, goal setting, big projects, and gives us an opportunity to think more expansively and do some planning.
And typically speaking, you also audit the entire portfolio, probably the whole team. I'm sure many things are said about myself, my performance, how I've done, I would assume. Hopefully, only nice things were said, of course. And not only myself, but the entire team, the virtual assistants, kind of, everything in between from the smallest to the highest in detail, the biggest stresses, and maybe the little thorns in the side that you wish to remove. Is that correct?
That is correct. We do a lot of personnel talk during these sessions, and there was multiple promotions actually coming out of this offsite, which we won't announce quite yet, but some promotions. And also Kent did mention that you interrupt too much in the earlier podcast, but I assured him that as of the last few podcasts, that is no longer ever going to be an issue. So yes, your name did come up actually.
Very good. Well, it happens. And it is something that I'm working in, not only in the world of this, and I'm fully accountable for my mistakes in reference to that. That's been something that I've struggled with, actually. So full disclosure, I'm very open to criticism. I am aware of a lot of things that I think I do well, and also more importantly, I think about things that I do wrong more, and that is definitely something that needs to be corrected and will be corrected, and will only benefit this show, but more importantly than this show, just every endeavor in life, whether it be the smallest or biggest conversation. I think it's really important to always have high EQ and self-awareness. And that is something that is not going to be an issue moving forward, because I will correct it.
I agree. And, we also, I think what would be interesting for people to know is that we had a voice lesson today. So we're doing some voice lessons, some speech practice and things like that, always trying to level up. I think that's hugely beneficial. That's something that I did last year. And so now we're doing it together for both of our benefits. So that's really great. And also to your point, I've been doing podcasting and stuff like that for a bit longer than you. So I've kind of worked through my issues a bit more and I'm a bit more polished, but you are much more natural of a presenter and a natural speaker. So I think you are going to just catch up to speed and be even better really quickly. But also, it's not just about being a good podcaster. I think doing an exercise like this makes you a better speaker and communicator and salesman in the real world as well, right? Being in the hot seat recording a podcast actually makes you better in the real world as well.
It's very interesting because for everyone who is listening, watching, for all you people, we love you. I have never heard myself really speak to this extent. I've never been on camera. I've never done any video work. So I appreciate to those who are listening still, despite how awful I was, in my opinion, to start. So we're only going to get better at that. I cringe, and it hurts me inside to watch myself speak, and to know that all the interruptings and stuff, my skin was crawling a bit. But that's how you grow, is probably through the discomfort. That discomfort has oozed through me, and you'll only get the best version of myself moving forward. And one thing we're actually talking about, we'll probably end with it, but it's just the concept of leveling up in all aspects of life. So we're really excited to dive into that. But without further ado, where are you located? Are you in the office right now? It looks as if I've seen those walls before.
Yeah, I'm back in the office. I tilted the desk a little bit more facing the window so I could have slightly better lighting. I was jealous of your very clear kitchen lighting last time, so I wanted to get my lighting a little bit better positioned. And what are these log cabins behind you?
Yes, so this is my family's house in Oregon. I love it here. So this is the backyard. It's very peaceful, as you can see. It's in Bend, Oregon, really close to Crosswater Golf Course. For those whom are familiar with the Central Oregon area, really close to Sun River as well, it's just incredible out here. We're on probably maybe two of the farthest points away from one another in America, but wouldn't have it any other way.
Fair enough. Fair enough. All right. Sounds good. Well, let's go
Yeah,
ahead and get started.
absolutely. So first thing I want to speak on right now is something that's interesting as we're now on August 2nd, which is crazy. I don't know where the time went, but first half of 2023 takeaways, thoughts, comments, concerns. What was kind of some of the themes that you thought of for the first half of the year?
The biggest themes of the first half of the year for the economy as a whole have been inflation and jobs. Everyone's been watching inflation and jobs very closely because supposedly that's what the Fed is looking at when they're making their decisions, right? The Fed claims to be data dependent, and well, that's the data that they're depending their decisions on. The reality is, I don't think they're quite as data dependent as they claim, because if they're looking at the leading indicators, then they would be seeing the economy slow down. But the reality is they continue to raise rates, right? And they just raised them a couple weeks ago now up to 525. And the market now thinks that they're going to stop. There's a 25% chance that they hike again in September, which is honestly kind of scary and higher than one would like to see, but those are the numbers right now. But if you look at inflation, and depending on what you're measuring, inflation has come down over the first half of the year. So meaningful progress has been made in the fight against inflation. And the reality is, and I don't know whether this is 100% true or only partially true, but the reality is there is a lag between the Fed raising rates and those rate hikes actually having an effect in the real economy. So if the Fed is looking at data that's coming out this month and then making a decision to hike or pause or lower rates, then that's being a little bit not, it's maybe data dependent, but it's being data ignorant, because if you're raising rates based on today's data, well, that's not going to help, because those rate hikes of today aren't going to impact the economy for another approximately 12 months. So that's something to really think about and recognize that where we are today is in pretty meaningfully restrictive territory. So for everyone kind of thinking that we're having this soft landing that's happening right now, I would argue be careful, because this is only the beginning, right? Because it isn't, historically speaking, it isn't until the Fed starts cutting rates that the economy actually starts losing jobs. So to think that we could raise rates as dramatically as we have and to put rates into restrictive territory without losing any jobs, I think is missing a key factor here. So that's kind of my take on the first half of the year. We've kind of just been sideways and gotten, stock market's kind of up and down, and real estate's been kind of on a pause. So it's been a sideways market, not necessarily up or down. And so it's going to be interesting to see moving forward whether we can break out of this sideways pattern.
Right. So with all that being said, how has it been on our firm's end for, raising monies the first half of the year, finding deals, operating the properties, rents, things of that nature?
Well, as of today, August 2nd, we've closed 2 properties. As you know, we closed Candlelight Park in Dallas and we closed Azul in Houston. These were very good deals in spite of how difficult the market is. So that's something to be very proud of and makes us excited. And I think we never really gave up hope. We always know that there's good deals in any market. But I could imagine a lot of people over the last 6 months, 7 months, gave up hope in some way, because they're looking at deal after deal and nothing looks good. Everything makes no sense, because as we keep talking on this show and elsewhere, the gap between buyers and sellers remains very wide, and that's preventing deals from getting done. Transaction activity is down anywhere from 75 to 85%, depending on the market and what metrics you look at. So that means there's an incredibly little amount of activity, which in itself is kind of propping up prices a little bit, but that's still indicative of the fact that buyers and sellers just can't get together and just can't get deals done. So we have to be incredibly proud that we did close 2 deals so far this year. And we talked about Azul on the last podcast, which it was a unique opportunity. Candlelight Park also was, I don't want to say too unique of an opportunity, but we really got a great buy there. So we have to feel very good about that asset and to be able to lock in a fixed rate loan. I think we're going to look back and be very happy on these buys.
That's awesome. That's awesome. And Candlelight, do you want to dive into that just ever so slightly about that one, or too far in the past for you to care about?
No, we still care about it. It's just, it doesn't have a super unique story. I mean, we bought it from a large seller that was looking to unload some of the deals that they have a little bit of a better equity position on, so that way they could rebalance the portfolio and kind of help some of their struggling properties. So I don't want to say that they're a distressed seller. Certainly the property exhibited no property level distress, whether it be financial or operational, but the portfolio level had some stress on their end, which made them motivated to sell, which when you have a motivated seller, you can possibly get a better deal. And so we struck that deal much earlier in the year when, again, there was not much going on, and bought that deal for about 120,000 per unit, which is a very quality basis down there. So yeah, and if anybody listening wants more information, we're very transparent. If you're a potential investor and didn't invest in that deal and want to look at the data room, Craig and I would be more than happy to send that over.
Yeah, our books are always open. We pride ourselves on communication and transparency. So if you ever need anything, want to learn more about us, want to follow us on the sideline before maybe working with us, or anything of that nature, always reach out to us. Our emails are available, and we'll remind you guys of those at the end, of course. So switching gears back to the first half takeaways of 2023, what were some of the things that big shops, private equity people are saying, some of our retail investors are saying? What was kind of the overall feel and feedback they got when you presented them opportunities, in your opinion? What was the overarching view?
So the fortunate thing with Candlelight, which we closed back in March, was the timing was better. It was already starting to get harder to raise capital and the mood shift, but we were still able to pull it off because the environment hadn't really turned too much yet. And then Azul, as I think we discussed last time, was entirely 1031 exchange equity, which is a bit unique equity because they're agnostic to the market. They need to replace that equity into a new deal one way or another, right? So that's money that has to be invested. So 1031 exchange is unique, and that's one of the reasons why we love it, because it's a bit more of a consistent source and a unique source of equity capital for us. So we plan to certainly continue to lean into that and partner with more 1031 exchange investors. But if you are a conventional investor today, you are potentially sitting on the sidelines, or you're being very cautious, you're being more selective. There's, on the one hand, there's maybe less deals going on, but there's less capital out there. So it's kind of the balance has shifted more into the capital's favor, so that they can be a little bit more picky. Whereas maybe a year and a half ago, there was a ton of money chasing so many, maybe fewer deals, fewer sponsors. And so it was a bit more so in the sponsor's favor in terms of those things. So yeah, we're seeing it slowly shift and get harder and harder to raise capital as people get, I think, just a little more conservative and a little more worried. And that sort of fear that's creeping in is going to really have a major impact on the market. And that's something that I do want to talk about, just in terms of market dynamics and what we're seeing in cap rates versus interest rates and things like that. So maybe you can share a little bit more about what you're seeing on the equity side, and then I can cover the realities of kind of capital demand and flow.
So the first deal we did in Duncanville, Candlelight Park, basically raised itself for the most part. There was a ton of interest there. We were almost oversubscribed. I'm not going to say oversubscribed like some people said on the webinars, of course, but we were really close to being subscribed and filled out, basically pre-offering it. And then similarly to Azul, we didn't even go public with it really, to be honest. We had a bunch of pent up demand from 1031 investors, as you just alluded to, which, took the equity up and made things very simplistic on our end. But those deals have done very well. And then a deal that I don't really want to get too much into, we raised a ton of capital from our friends and family pool and whatnot, but the delays on that have been kind of tough. So we're just kind of battling through that right now. But that property went well. And now we're raising on a deal currently. And I'm not going to say it's going poorly. It just definitely seems as if the attitude's slightly different, people a little bit more cautious. And a big thing that investors are going to have to get trained to seeing, and there's a couple of things. First off, investors are going to get a little bit snake bit right now, because there's deals in which, with other sponsors, of course, not us, because we haven't done a capital call, but there are some deals where the fundamentals and things are not going very well. So we have to battle against that. That's a institutional wide situation that, unfortunately, when things go up, everything's great and everyone's happy go lucky. But when things go down, we all kind of get put in the same bucket. So some people might not be making their investments, and there's just less money to maybe be flowing around, or people don't really know what the result of their investments are going to be. So therefore, they don't necessarily feel comfortable on investing. And that's one thing that I have seen. And when I speak with a lot of these investors are, hey, I really like the deal, but some of my deals are kind of messes over here. And before I deploy any capital, I really want to see what's going on. And I'm just a little bit apprehensive to kind of get into that world. And maybe they feel as if stocks, bonds, and maybe the S&P 500 makes a little bit more sense right now and is a little bit safer than, a deal that we have to offer, despite our conservative in nature underwriting and how our deals presents. And then it seemed as if, when we sent it out to some of the bigger shops outside of our own capital group, was situations where half the firms would look at it, but for some reason they would move the goalpost, or they were just being very selective. We did get yeses from bigger shops as well, but it seems as if a lot of groups are pencils down, and we're actually going to get into that subject later. When people are pencils down, what does that mean, and what do they do all day? Because I'm genuinely curious, because I would go crazy if I wasn't working towards a deal or doing something. But it seemed as if people are becoming a little more picky, and a big thing that people need to recalibrate on is just the leverage points, interest rates, where debt needs to come in at, and maybe seeing a slightly lower IRR due to leverage points and whatnot, and just everything being digested in real time as we speak. It's just, there's always a adjustment period, and we're certainly in that middle of it right now. To your point, that doesn't mean that they're bad deals, and we're buying a deal right now that we're buying it less than the seller bought it for in 2019. And if you think about that, that is wild to think that someone couldn't make money on a deal when they bought it in 2019. I almost think if I was blindfolded and I threw a dart somewhere and I bought something in 2019, I sold it now, I could probably have made money on it. But that reality is not going to be true for everyone. So curious to know your thoughts based upon that.
It's not true for everyone, and it's not true for every market. But there's a lot that you said there, and some things to unpack. The capital calls on existing deals are going to kind of weigh on people's psyche, and not necessarily prevent, but they're going to make people think twice about investing new money, right? If they're busy meeting capital calls, or maybe not even meeting them, but just being mired in capital calls and going, oh gosh, my current deals aren't going well, I'm busy kind of worrying about those, I don't have time to, or have no interest in thinking about new investments. So it's still very early days for those things to unwind. As you said, there needs to be a recalibration in the market, because we went from high prices, high leverage. Now prices have adjusted down, leverage has adjusted way down, and that's going to cause owners of real estate to have to find ways to stay alive or recalibrate, whether it be through capital calls, through recapitalizations, refinancing their debt, cramming down the equity. Not all of real estate investing is pretty, right? There can be some difficult situations, and I do believe, unfortunately, there are going to be some difficult situations ahead. So as that happens more and more, it's going to make it harder for people psychologically to want to invest. And what's fascinating about this is just a truism of all markets, not just real estate, but all financial markets are led by human emotion. And so when we experience the negatives of our existing deals, and that depresses the psyche of all investors, that's going to push prices down, right? Because if there's less people interested, then the deals have to trade at a lower price. And lower price means higher cap rate. And so I believe we're going to see slightly higher cap rates in the next year or so. And that's going to create a more attractive buying opportunity, because at the same time, and again, this is just my projections, and we're not, as a firm, we don't invest based on what we think about the future, right? We're not trying to be market timers or predict the future. We invest on today's fundamentals. But just me personally doing some thinking, I think cap rates are going to expand a touch, just generally speaking. And at the same time, I think interest rates need to come down. So we're going to experience over the next 12 to 24 months a period, and it's going to be a short-lived period, because the opportunity to make great returns is never a long period, right? People are going to wake up and then it's going to be too late. But we're going to see a period where cap rates are going to be widened out at the same time as interest rates come down, and we're going to see a decent spread between cap rates and interest rates. The last time we saw a spread that was substantial was in 2020 during COVID. And so that closed super fast. And the reason for it was March, COVID hit, April, May, June, everyone was wondering, are tenants going to pay their rent? Is the world going to end? Am I going to be able to get financing?
Am I going to die?
Am I going to die?
Literally, am I going to die? Yeah, that's
Am
how
I going?
information was, and of course, if you're sitting inside all day like many of us were watching the news, all you saw was deaths and people in body bags and hazmat suits and stuff. So hysteria and fear was rampant at that point, and transaction volume died, but then rates cut, and everyone was a hero who bought in that process. So
right, so if you're watching the news, like you said, then that's going to depress investor psyche. If looking at the stock market, it's all depressed. However, if you were to have invested in that period, right, you would have been able to buy deals, good quality deals, for around a 5 cap. And at the same time, like Craig said, the rates dropped and you'd be able to finance at a 3. So you'd have a 200 basis point spread between cap rates and interest rates. And if you had a fixed rate and locked that in for 5, 7, 10 years, that's an amazing deal. But that window was very short, because once the new year came around, January, cap rates dropped 50, 100 basis points, and that gap between cap rates and interest rates shut. So those gaps those opportunities are short-lived. It's easier to catch the falling knife than to try to time it on the upswing, right? By the time you're trying to time the upswing, it's already too late. So, I mean, we advocate buying in all points of the cycle, but if you can, obviously time the bottom, perfect, right? But market timing is very, very difficult. And it's even more difficult to try to catch it on the upswing. So I do think we're going to see a period. Maybe it's as attractive as COVID, that 2020 period. Maybe it's less, maybe it's more. I don't know, but there will be an opportunity coming up where there will be a better spread between the cap rate and interest rate, which will make deals pencil more attractively. However, the very reason why that opportunity is going to present itself is the exact reason it's going to be so difficult to raise capital. It's going to be hard to access debt. It's going to be hard to access equity. Equity would be nearly impossible to raise. Who was raising equity in 2020? Almost nobody. Who had the guts to put a deal under contract and go to their investors while their investor might have been dealing with a family member dying from COVID or something, right? So,
or his money just got washed in the stock market because the massive plummet that happened roughly around March 17th, I want to say.
Exactly. So the very reason why an opportunity is created is also the very reason why it's so difficult to deploy capital at that time. So it's just, investing is not easy, and you have to be prepared. And this is why we want to be nurturing our relationships constantly talking about, constantly in touch with our investors about deals, about opportunities, so that when these opportunities arise, we can all stand together, confident, strong, and take the plunge on these deals, which will turn out to be home runs, but at the time will be difficult to do.
So I have so many points to add to that. Number one, just real quick to the last section you made, is to reach out to people. One thing that we are going to want to do is, is reach out to a lot of our people that are in our professional network to kind of not pre-fundraise, but to reach back out see what their timing looks like, see what they're looking for, see if they are going to be coming back into the market in, H2 of 2023, if their pencils down until 2024, things of that nature. So we want to get ahead of that, to your point, to make sure that we're not missing any opportunities during that blip of time that may be the best time to buy, perhaps in our careers to this point.
Well, I don't know about that. I think these markets are going to come and go, right? Market cycles 5 to 10 years or something like that. So I think there'll be more opportunity, but it is not an opportunity that you want to let go to waste.
For sure. So you also mentioned that you believe cap rates are going to expand coming up in 2024. Is that correct?
Yes.
Or maybe just from now, call it till maybe 2025. Is that more of an accurate statement, would you say? Slowly but surely.
Yeah, something like that.
So does that make you feel uncomfortable to buy right now? I know you said we want to buy in every market, which I'm a believer of as well, but what's your, I guess, your hot seat scale 1 to 10 on buying something, and how much more sweet does a deal have to be for you to feel incredible about it?
So here's the reality. When you buy a property today at, let's say, a 5 cap, and let's say cap rates widen to 5.25, that doesn't mean you lost any money. That doesn't mean that your rents went down. That doesn't mean that you're receiving lower cash flow distributions. It just means that the valuation of the property is lower. So if you are a long-term investor and have the ability to endure a short-term fluctuation in value, then that's fine. It doesn't really affect you. So if you can look at a deal today and it's a good deal to you today, then buy the deal and it's a good deal. And don't worry about the fact that you maybe could buy the deal at a lower price in a year from now, right? Or 6 months or something like that. If it's a good deal for you today, buy it, because this game is not easy. It's not easy to time markets. The opportunities open and close quickly. So rather than trying to time it, if the numbers make sense and the fundamentals are good today, then lock it in. As we've discussed before, we are believers of long-term fixed rate debt. That really makes things a lot easier, because if you are doing a short-term deal that you're relying on a 2-year or 3-year hold to pull off, and if you don't pull it off in that window, things go bad. That's a much riskier bet than to say, all right, well, we're going to lock in 7-year, 10-year debt, and at some point in time, the deal's going to work out, right? We have a 10-year window to make the deal work out. That's a whole lot easier to bet on than a 2-year window. So making the game easier for ourselves with fixed rates and longer term debt is a cheat code, especially when you're buying in less certain times like today.
It's funny because as I was driving up yesterday with my dad and mom from the Bay Area to Oregon, 8-hour drive, by the way. It was kind of tough. But with that said, one thing that my dad mentioned was, in the world that you're in, you really can't lose the game if you don't leverage and over leverage too much. You'll be in the business forever if you don't over leverage. And that really stuck out to me. What also that reminds me of, and this is just a side story, but this is a crazy 2008, 2009 recession story. So a gentleman who used to own a property on the same ranch that my family's in here in Oregon was one of the biggest issues of the recession in Oregon, actually. He bought everything with sub 10% down. This is commercial stuff. And this is when they allowed leverage like that. This is when when debt and things like that was a lot easier to procure. Obviously in 2008, 2009, 2010, laws and regulations changed, but he basically would get up to, I think my dad said, about 5 to 7% down, and then refinance all the equity down to 3% in it, and do that across his entire portfolio. And this was hundreds of millions of dollars. Well, what happened? Things changed, the market changed, and because of that, everything foreclosed, and it really left actually the state. There was a lot of bankruptcy issues and stuff. And Oregon is the first state in the recession and the last state out of the recession. As my dad always says, and many other people do as well, it's not the most economically resilient, historically speaking. A beautiful place, but not the most robust in that regard. And, side note, it was just very problematic. But the point is that if we play the game of, not maxing out leverage, not doing anything crazy like that, our investors will be able to sleep well at night, and we'll be able to win the game. And the time horizon of 5, 7, 10 years, it's just a more predictable game as opposed to the in and out world.
I agree. Yeah, you can make money, but you can also lose it. So it all depends on what kind of game you want to be in.
Absolutely. Well, any final thoughts on that? I think you maybe tabled something that you wanted to come back to, or had we discussed what that thought was?
I think I covered it. I covered the idea that people are today sitting around going, "Oh, I want to invest in a deal with positive leverage." Well, unfortunately, that is rarely the case and rarely available. But when it will be available, it'll be precisely the time that you will not want to invest, because you'll be licking your wounds and you'll be have a very negative sentiment, because the news will be bad, the stock market will be bad, and sentiment will be bad.
Yeah, you may have a little PTSD from other problem childs that you're worrying about within your portfolio, or things of other natures as well. I had a couple questions I wanted to ask you based upon that. The first would be, if you were the Fed, and if you were Rob Powell, what would you do right now, if you were in charge? If you're on the hot seat, what decisions would you make regarding that, and how would you handle and make things work? Because you said that usually when rates get cut is when the market gets bad. Rates haven't been cut yet. It definitely seems as if we're inching closer to the point where that may happen. Some say the economy is more resilient. On All In last week, I think the crew was talking about how maybe the economy is more resilient than what we give it credit for and what's going on. Maybe the Fed has been working. What is your take, and what would you do?
Well, I would certainly, if I were to take over from where we are right now, I would certainly pause and not raise any more, because we are in substantially we're in restrictive territory. So current interest rates today are restrictive. So I don't know if there's more brake that needs to be applied to the pedal. I think now it's just a wait and see to see how the market digests, how the economy digests these restrictive rates, and see how the economic data performs over time. I think less is more at this point. The Fed's fairly confident that they'll be able to cut rates when they need to, right? So it's easier to cut and it's harder to raise. So I get why they've been raising, and as much as I don't like it and it hurts our business, I get it. But that's where I would be. I would be in a pause and wait and see, and really give the economy time to digest. There was one other thing that I wanted to mention, which is the inverted yield curve. So the yield curve, for those that aren't familiar, is the spread between either the 2-year US Treasury yield and the 10-year Treasury yield, or SOFR, but basically short rates compared to long rates. And so in a healthy economic environment, you would see short rates be lower than long rates. And that makes sense, because as a lender, you would want to be paid a premium interest rate for loaning out your money for longer. And that just makes sense. It's called a term premium, right? If I'm going to loan you money for a day, I'll take a lower rate. But if I'm going to give you money for 10 years, I need a little bit higher interest rate, because that's a long time to have my money out, and maybe you can do something bad with it and I don't get paid back. So that's term premium, and that's the yield curve. And so, like I said, in a healthy environment, the yield curve would be positive sloping, where longer term rates are higher. However, today we have an inverted yield curve, which means the opposite. It means that the long end of the curve, or the 10-year US Treasury yield, is actually lower than the 2-year US Treasury yield and SOFR, which SOFR is the short overnight financing rate, something like that.
Secured overnight financing.
Secured overnight financing rate. So with these short rates like SOFR, and which used to be LIBOR, and the 2-year US Treasury yield being higher than the 10-year, it's really a reflection of an unhealthy market. And it's quite a complicated thing, but very simplistically speaking, an inverted yield curve is arguably the single best leading indicator of a recession. Yeah.
Yep.
So,
Yes.
and
And
it's
it's
about 18 months.
It's been inverted for a very long time.
So I want to say it's been inverted for about 18 months. And on average, you have a recession after 18 months of inversion.
as Paris Robbins, my good friend, and you know him, of course, because we shared some nice time together in Positano, summer of 2020, had a nice boat day
Or
with him.
2021?
2020, no, 2022.
Ah,
2021, we were in Greece. So correction. Yeah, life's really rough for us. But he's been very, very adamantly saying how the yield curve is inverted and so on and so forth. And he's been hitting that. So to your point, it just tie back together there.
yeah.
Yeah.
And normally when we see the yield curve invert, it kind of just slightly inverts and then it goes back to normal, maybe inverts a little bit, 10, 20 basis points. I mean, we're talking about the inversion today is almost, it's almost 100 basis points of inversion. And if
It's
you do
in,
SOFR versus the 10-year, it's even more than 100 basis points. So that's the deepest and longest yield curve inversion that we've ever had. And it's the number one indicator of a recession. So that's a scary data point if you were to single out one data point.
and this is something interesting. This is what I talked about my dad yesterday in the car ride up, who works for Morgan Stanley. He's deep into the world. And he's like, listen, the reality is that we printed so much money. It was on a historic level that this is just probably the byproduct of it. And this is maybe the reason why this has been as long as it has, because there is some corrections that need to go on due to the lingering effects of COVID and pandemic and things of that nature.
Yeah, that's exactly right. When we printed a lot of money, a lot of it went into the stock market, a lot of it went into the bond market, and specifically into the long end of the yield curve. So if you have a lot of money buying bonds, the 10-year treasury, for example, that's going to push the yield down, right? It's similar to a cap rate concept, right? If the price is here and income's here, and then you're bidding up that price, well, that makes that ratio of income to price lower. So that pushes down the yield. And the Fed only can control, well, I can't say only, but through their monetary policy, they can only control essentially SOFR, which then has a reverberating effect across the curve. So when the Fed raises rates, that raises SOFR. And then the 2-year US Treasury is a reflection of what the market thinks SOFR will average over the next 2 years. So it's not, the Fed doesn't exactly control the 2-year Treasury, but they're connected. And then as you go out longer in the curve, those yields are really just determined by market forces, buyers and sellers, global liquidity. Also, where do people think inflation is? Because why would I care if the government's paying me 4% if I think inflation's 6%? Why would I lock in for 10 years a guaranteed negative return for 2%? Well, the answer is maybe because of currency instability or because it's the best place to be, right? We saw negative interest rates for a long time in Europe and real negative interest rates in America. So, and I think we'll go back there. So that's a lot of economic talk, but I just wanted to bring up the negative yield curve and how it needs to be fixed. You can't, I don't see how we could live in a world with a negative yield curve forever. And so how do you fix the negative yield curve? Okay, well, simple. We either need the 10-year US Treasury yield to go up enough such that it is higher than the short-term yields. So call it, we need a 10-year that is north of 5%. I don't, that's not going to happen. That's insane. So then the other option is to reduce the front end of the curve such that we get back into a positive slope. Well, that's more possible and that's more likely. I think we will see the front end of the curve, which would be the Fed leading the way, cutting rates, getting SOFR back down to 2.5% or something like that. That would put us into a healthy, positively sloping yield curve. So I'm not sure exactly where we want to take that, but that's my putting my economic hat on and my economist hat and
So that's what you would
breaking it
do.
down.
You would fix that.
Well, yeah, I mean, I can just simply wave my magic wand and I can lower SOFR and maybe even lower the 10-year while we're at it.
Exactly. That'd be nice. Well, for our benefit too, of course, and to make our deals pencil, that'd be
Maybe
great.
just for us. Maybe we'll just lower the 10-year just for us.
Yeah, we'll get an exclusive deal. Correct. Correct. I love that. Awesome. So switching gears to the next topic, because we nerded out on that for a while. And this is something we've heard a lot is, oh, we're pencils down, we're pencils down. That's more of, private equity firms and, maybe REITs and things of that nature for, equity deployment. But what do firms do in slow markets and what do they do when they say they're pencils down? Do they simply just go on vacation? Do they go to Barbados? Do they go to Costa Rica and hang out? Do they go to their summer homes? Do they go to their winter's homes? What do they do? What does their day-to-day consist of? I'm genuinely curious, and perhaps you do know the answer, perhaps you don't know the answer. Perhaps if you're someone who is in a private equity office that is pencils down, I'm all ears. Please reach out to us regarding that subject, because it is very interesting to think about.
Well, finance, venture capital, private equity, real estate is in a recession right now. Who do you know that's hiring in VC land? Right? Very few people are hiring. There's really not the sexy Facebook job where you could sit around and do nothing and make 200K or something like that. That doesn't exist anymore, or so I'm told, right? So the reality is, if a firm's not doing as much and they're not actively raising or deploying or doing due diligence on new acquisitions or chasing deals, then the acquisitions team is probably getting scaled down, right? Someone's getting fired, unfortunately. Things are potentially getting trimmed, or those resources are being reallocated to asset management, because in a market like this, a private equity firm or similar may be experiencing difficulties in their portfolio, and they're working on refinances. I mean, we went through that earlier this year, and thank God we pulled it off and are sitting in a relatively strong position as it relates to our portfolio. But we went and did over $100 million of refinances. That was so much work, right? It required everyone to step in and help. So there's a lot of work on the asset management side to roll up your sleeves and work on, okay, we really need to drill down and trim expenses. We need to right the ship on the capital structure. We need to also, something relevant for me and you is double down on investor communication. We need to make sure that LPs are feeling comfortable, feeling confident, they're informed, and we're not backing away from questions.
They feel that their capital is secure, because if they feel security with us and everyone else is not making them feel secure, well, when they're ready to make an investment, where do you logically think they're going to go to? Ideally, us.
Exactly. So we're working really hard today to preserve the success of our existing investments, and also, as you said, to double down and earn even more trust from our investors, such that when we come out of this, that's when we're really going to make the leaps to, well, we'll really reap the rewards of our efforts, right? So yeah, I mean, there may be less going on as far as transactions right now, and that may mean people are scaling down on personnel, but there's also plenty to do on the asset management side. So I think that's what a lot of firms are doing when they're pencils down. I think also pencils down is a convenient phrase to basically say, hey, we don't really want to look at your deal very deeply. So we haven't even looked at your deal deep enough to find a reason to reject it. We just know that we're not going to like it.
Yeah. Yeah. There's a lot of that going on for sure. Well, that's interesting. And then another topic and thing I want to speak with you about would be capital raising market in 2023 and beyond. So we've kind of touched on that, but just to kind of put a bow on it, I mean, we definitely think it's going to get tighter as time progresses. People are being a little more selective, and just like how everything you could invest in turned into gold from that golden period of basically 2019 to 2021, I would say 2022, probably not so much, but maybe let's just call it 2018 to 2021. Anything you invested in there likely did incredibly well. But now things are changing. Hot money is leaving the space. Where do we go from here? What do you think it looks like as we close out? As the phrase goes, you said survive till 25, but maybe would you like to add a little more color to the feeling right now that we're experiencing?
Yeah, so survive to 25 is being tossed around now as a way to kind of rally around your existing problem assets. So if you have a problem deal, it's struggling, it was over levered, overpaid for, and things aren't going as planned, surviving to 25 is the idea to, hey, let's get over the hump of these higher rates. Rates will cool down. We'll be able to refinance and restabilize the deal and right the ship and hopefully get back to distributions, hopefully avoid a capital call, hopefully avoid losing money. These are all very real concerns. So survive to 25 is really a mantra for existing deals. Now for capital raising for new opportunities, like you said, it's, in our opinion, it's going to get harder and harder. People have already started talking about how, oh my gosh, raising money today is so much harder than it was 6 months ago or a year ago. I'd say at this point, more like a year ago and plus. But in my opinion, and I think you agree, is it's only getting started and it's actually going to get harder, which is such a shame because that's going to be, as we discussed, precisely the right time to be deploying equity, which is why we're going to be working twice as hard to raise the capital that we need, because we're going to have strong conviction in those investments when they come.
We'll probably have to work twice or 2.5 times as hard to raise about 80% of the money as we had before. But at the same time, with leverage down like this, and when rates do get cut, we'll be able to buy, when the deal does well, probably double the deal size with the same amount of equity we raised on the front end, which is something to be excited about. So there is the law of, things just really working out if you stay in the game long term. And, if you just make it through this time period and hold true, you are technically recession proof, and we'll be at such a cool point in our kind of careers, but also as a firm history where, ideally we're 7 years through, we're almost at the 10-year mark. Just getting it to 5 years is tough enough. But once we get to 7 years and 10 years and beyond, we've gone through a market cycle, we've been stabilized, and we've held tight in the pocket, is when I think we'll really expand even more and more.
Yeah, I couldn't agree more. So for people who are concerned about their ability to raise capital, I would, have conversations today about what's coming. And I'm not saying doom and gloom and there's going to be a depression coming, but I think just looking at the realities of the market, I think the market's going to get more challenging. And at the same time, there's going to be opportunity. So raising equity is going to be tough, like we keep saying, but it's going to be critical if we want to take advantage of the opportunities that are going to be there in the market.
Absolutely. And there's some partners that we've seen that, just unfortunately have thought they could raise something and end up with an entirely different number. And we appreciate that. And, we're not going to hold anything against them in that regard. And we understand that this is a tough game. This is a tough process. We're in the belly of the beast right now, but the other side will be incredible. Switching gears from that, as a portfolio with about $350 million of assets under management, in your opinion, when do you think we'll go full cycle on everything and kind of flip through and go from, all right, we've got everything here, we'll probably be through most of the business plans, the stabilization process, the renovations, the CapEx budget. We'll probably, turn through that and get the plans going. When do you anticipate we'll probably unload all of those and ideally 1031 exchange into the next deals? Is that something that's a 2025, 2026, 2027 thing? I know your crystal ball works really well and it's on your desk. So if you want to look at it and touch it, by all means. But if you want to go free with it, what do you think?
So unfortunately, for us and everybody else who bought in the last few years with the business plan to exit in, let's say, 3 years or 5 years, that's probably getting extended by a couple years because of everything that's going on right now and with rates. And sure, you could sell today, but you're not going to get your price that you were hoping for, most likely. So that's going to cause you to want to be patient and wait, work on the deal a bit more, wait for a better capital markets environment to sell for a higher price. And we're no different. We're not unique to that issue. So we're probably going to turn over the entirety of the portfolio, as you said, in probably the next, 4 to 6 years. So that's a lot longer than all of us would like. All of us love the sexy deals where you buy it, quickly pop the revenue, and then you're able to sell at a compressed cap rate, and voila, right? You've made a nice 30 plus IRR.
And
so,
you're a genius.
And you're a genius for that. Yeah. So, I think the real geniuses are going to be revealed over the next 2-3 years by the account that they did not do any capital calls, did not lose any investor money. Those are going to be the real geniuses, because I think it's harder to protect investors in the downside than it is to make money for them in the upside. So that's where we're really going to prove ourselves. And that's unfortunately the way it has to be. But on the other side, like you said of it, on the other side is where the big rewards are. So we're prepared. We're excited, very excited, I would say, to go through this process and see what the other side has. So that's when I think that we'll sell all these deals. And of course, always be buying. So we'll be hopefully never shrinking the portfolio, because, we're not just a hedge fund that just buying and selling properties willy-nilly. We are an operational business. We have an operating company, right? Radiance Living is our property management and construction management arm. And so we actually own these properties, actually manage them. We renovate, we work with tenants. We have over 50 employees across the properties and at the corporate level. So all these things and people matter. And so we don't want to just sell all these deals and take our profit and leave, right? We want to actually continue to grow a portfolio, build it, scale it. With more scale as well, we'll be able to afford better personnel, more hands-on personnel to improve the performance of the portfolio as well. Which, speaking of which, we actually just hired a regional vice president to oversee the management portfolio, which is really going to be super helpful. And that's going to allow our EVP, Aaron, who kind of oversees that person and oversees Radiance Living, to come up above the fold and really dive into things that are going to move us forward, not just kind of keep us going.
Yeah, and just to piggyback off of and extend off of what you were saying in reference to just improving the experience, the improving experience will only give the tenants a better opportunity to have a better place to live, a safer place to live, which means it'll be a better community in the areas we invest, which is really important to us. And then, of course, our investors will have a better experience. And then, therefore, our life is a little less hectic. So it's all encompassing what's going on. But to kind of tie all those things together, every agenda gets hit, every kind of side of the real estate process, because ultimately this is a human business, the real estate world. It really is. We're talking about where people live. You only need to live life once. So, it would make me sick to my stomach to think if we had a property that was not safe in our portfolio, where people had to spend a part of their finite and precious life in a building in which they didn't feel good about and were uncomfortable in. That would just make me sick and, wouldn't make me feel very good. Although we like making our money too, there are more things, more to life than just money. So we do think about things like that very often, and improving everyone's experience and giving everyone the best experience we possibly can is most definitely top of mind for us in every aspect that we do in the business, operations, client servicing, underwriting, everything, you name it. It's just the focal point.
Sounds good. I'd also add that we are extremely passionate about the preservation of affordable housing.
Yes, most definitely. Most definitely. Well, we have deep dived very nicely. I think we're just shy of an hour now. Let's shut 52 minutes. Very good. I want to switch into something that is a little bit more near and dear to me. And I think I can actually go outside because the gardeners are gone, which is nice. And I have some materials and goodies that I want to share with everyone. And I'm actually going to invite everyone to consider to kind of implement some of the things that I have been doing to my life. But we've kind of had a concept, and Rob and I talk about this very frequently, which is just the premise of always leveling up and becoming your best self. And one of the ways, if you don't measure something and track something, it cannot be grown. I think you have said that to me over a dozen times, and it's so awesome. We do our KPIs, and sometimes I struggle to remember to put the KPIs in there. Don't hold it against me, but just to track things of that nature to level up, because you don't know where you're at if not. So one thing that I have done in this last month, I started in July, was actually doing a habit tracker. This is mine for August. It looks like this, just with things you want to work on. But last month, just some of the things, I'm not going to get into everything because it's a little bit personal to me, but for July, it was cardio, weights, 7 miles of walking, running, bike ride, 1 gallon of water, sauna, cold plunge, 50 minutes of reading or audible every day, pickleball, golf, no phone to start the day for 30 minutes, meditating, and then no Instagram. So those are just some of the things that I'm working on doing. Some of the things I fell absolutely short on, some of the things I did really well on, but it's just a cool thing to do to incorporate into life. And I wanted to ask you if there's anything that you've done, or if you've done anything like this. I believe you've got the habit tracking app, a little different than me, who's doing it on loose leaf. But what are you doing right now to level up and to become the best version of yourself?
Sure. So For me right now, my biggest focuses are I'm working with a wellness coach. And so I'm excited. And that's clearly you and I have that personality type where give us everything. We want to give us all the homework. We'll knock it all out. We want to do it. And he said, no, a habit takes 45 to 60 days to form. And so let's just focus on the one thing, the one domino that will knock down the rest. And that's what's going to give you the biggest result. And so right now, the biggest domino that we have is me putting my phone away, leaving it in the kitchen at 11 p.m., no later than 11 p.m., and then going to my bedroom, closing the door, and that's it. No more screens, no more electronics except the Kindle for the rest of the night. So that's a domino right there that knocks down so many, because putting the phone down before bed gets me away from the screen, which is great. It'll promote better sleep. It also makes me not on the phone at night because I can binge on my phone, go from one YouTube video to the next, and before you know it, it's 1 a.m. That ruins my next day. So instead, get away from the screen. And then number 2, pick up the Kindle, get some reading done. Okay, that's fantastic. Reading is good. And then go to sleep, and then wake up, get more sleep, feel more refreshed. And that allows me to tackle the day more effectively, more productively. So that's a big domino there. And also the other thing we're doing is with the wellness coach, I bought an Aura ring. And so the Aura ring I put it on before bed, and then I wear it throughout the night. And then when I wake up, I take it off. So I don't wear it all day. I just wear it while I sleep, and that tracks my sleep, which holds me accountable to my sleep. I can stare at it right there and go, oh, you did not sleep enough. You went to bed too late, or what have you, right? One thing that is interesting from tracking the sleep is I am a very good REM sleeper. So even if I don't sleep very much, I do get a good amount of REM sleep. So I'm a good sleeper in that regard. So that's good to see at least, but it's not good to stare at the thing and say, oh my gosh, I only slept 4 hours last night, right? That's unnerving, but that's my big habit that I'm forming right now.
That's awesome. So I've done there's been a lot of personal changes in my life, as you have noted and have been on the front row on. Everything's incredible, but a lot of changes. So, I think the best way to kickstart that is to be really intentional and to really visualize what you really want and think about things that are topical. So for me to go through and not check some of these boxes every day on my habit tracker that I did starting last month is really nice, because it reminds me, hey, you fell short there and it's okay. Like, give yourself the break, form the new habits. My biggest habit has been doing things that make me feel good. And I think the number one thing that makes me feel good is work and working out. My day starts with a workout. I run 40 minutes, or today I lifted weights, but I run 40 minutes every single day to start the morning without fail. I feel like if I don't run my day, I won't be happy if I don't do that. Like, legitimately, I'm that obsessed with it right now. And I hope I can keep this going for, indefinitely, because it makes me feel so great. You see me on the morning calls for LSD and I'm chipper and smiley as could be. It's like, oh, I wonder why. It's because the endorphins are flowing. I've got my movement in. And also in Arizona, which is my residence, if I don't leave my house before 10 a.m., it's too hot to do anything when it's 118 degrees legitimately every single day. So many benefits there. But for my ADHD self, it's very nice to exercise and get that out. And in
And
addition,
let's also let people know that LSD stands for Lone Star Daily. So our
yes.
daily call, we call it LSD, so everyone knows.
Yes, of course. And then my buddy actually bought me some things. My buddy Jason Glimsher, love you, back home. Very successful real estate agent out there, bought me 3 books very generously. He said, hey, I have something for you. So he got me the 5-minute journal. I've never journaled before, so I'm actually going to start doing that today. I'm really excited about it. The Daily Stoic, which he really recommends. And then The Daily Laws by Robert Greene. So I'm really excited to incorporate these little things in my life and see the trajectory it takes me on. I'm sure as your favorite employee, you're excited to see me going down this path of betterment and making sure that the mind body connection's there and I'm getting the best of myself for the firm. So
That's absolutely right. Yeah, I love it. No, book recommendations are always welcome, so that's good to see, and would love to hear from people listening what books they're getting a lot of value from right now, and next episode we can share some of our other book recommendations as well.
absolutely. Well, do you have any final thoughts before we close out here?
No, I think it was a great show. We flowed well, and really excited to keep on doing this.
Absolutely. And if you're ever looking for information regarding Lone Star Capital, if you want to learn more about us, if you are curious to know about real estate investing but don't know where to start or go, look no further than here. My email is Craig, Craig, at lscre.com. I'm not going to share Rob's. He gets enough emails, but just direct everything to me because Rob would just direct you to me anyways. So just cut out the middleman and go direct to me. If you're curious just about our event coming up, which will be, there's two events actually coming up. If you're in New York City and you want to donate blood, we have a blood drive coming up. I believe it is August 15th or
It
14th.
is 15th.
August 15th. And then, of course, we have the Lone Star Summit event in New York City, October 15th to 17th, which will be very exciting. This is the third time we've had the event. It'll be in where our office is at the One World Trade Center, not in our office specifically, but an incredible event space, which will actually have a great view of the Statue of Liberty. And from there, you can also just see, panoramic views of New York, all the way up basically to Midtown, where you can't see any further from there due to Billionaires Row. But it'll be a great event. And if you need any information, please reach out to us. Also, finally, to mailbag. We have a couple questions we're probably going to get into next week. We just didn't have enough time this week. But at some point, you may struggle with content. So if you do have a question that you want to get answered, please send it our way. Could you please share the email, Rob?
Yeah, it's mailbag@lscre.com. So feel free to send over anything that you think would be a good topic or a question to have answered on this show, and we'd love to address it.
We will also take anonymous tips as to things going on in the business. If you feel as if we need to become privy to it, let us know, or your hot takes or bold predictions. Just curious to know what the people are thinking. So always feel free to reach out to us via the mailbag or emailing me directly. As I said, Craig at lscre.com. Once again, thank you so much for tuning in. Episode 7, if I'm not mistaken. Can't believe there's already 7 of these out. Nuts. It all started from the trip we had in Cabo, Hunter Thompson's mastermind, but we're here now. Lots changed since then. Many great things. But excited to see what H2 has in store. Once again, thank you for tuning in. I'm Craig McGrother, the founder and principal. Rob Beardsley joined me. Thank you so much for being here today.
Thank you. See you guys.